Welcome to a very special edition of Shut the FUD Up. As always, Thursdays at 5 p.m., we give you every reason in the world to feel bullish about your investments and let you know that crypto's still got a long way to go before this bull market runs out of steam. Who's texting me right now? They just can't. Always, whenever I'm trying to do something else, they always do that. So, how about we start today off with our new theme song? If you haven't heard it, well, here's. Let's hear it again. Don't be making fun of my dance moves right here saying I dance like a white guy. Because I tell you what, like, if you saw the kind of dancing that I used to do, you wouldn't say I dance like a white guy, all right? That's a story maybe I'll tell you sometime. I don't know if I should tell you that story today here, but one of these days, maybe I'll tell you that story. So, we call this show Shut the FUD Up. Thursdays at 5 p.m., and it's Shut the FUD Up because I'm just so tired of all these people that are on Twitter going, "Oh, bull market's over. Oh, alt season canceled," when none of that is true. Absolutely none of that, for God's sakes. So, we're going to get into it today, but a few little things here I want to cover first. Oh, yeah, first thing is, y'all see this? This is my new American Eagle shirts. I just bought a whole ton of these things here from American Eagle. They got a whole bunch of these shirts that I really like, and I'm going to buy a whole ton of them right now just to piss the left off. Man, it makes me feel good knowing that, like, hey, I'm helping a company that the left wing absolutely hates because, God, it just feels great. Especially, like, you know, what we've learned recently is that, like, all these people that are ugly on the outside are also ugly on the inside. It's so nice that, like, we have that confirmation here that it's not the opposite. You know, that's not like pretty people are ugly on the inside. It's great that, like, we see that the horrible people are very easy to tell from how ugly they are. So, American Eagle, as long as you never apologize and you never cave in, well, you got yourself a lifelong customer, and I'm happy to buy as many of these shirts as possible. So we want to show you this thing here as well. Another, like, little special that I'm going to have for all you guys. This book, one that I wrote, it's called Your Parents Were Wrong: Debunking and Replacing Outdated Advice. You can get this book for free come next week. I'm going to show you how to do it. All right? Next week, Thursday at 5 p.m., I will show you how to get this book 100% free. And I promise you, you're going to really enjoy this. You'll really enjoy this book here. So make sure you tune in next week, and I will show you how you can get a copy of it 100% free. You can even get an audio copy of it if you really want to. But you got to wait till next week to find out how to do that. So mark your calendars. Make sure you don't miss next Thursday at 5 p.m. Or really, you can miss it, and you can tune into it later. That's the thing here about these live streams, is that they're recorded, and they're right here on YouTube on demand anytime you want. You don't actually have to catch me right at 5 p.m. on Thursdays. But if you wanted to, Thursday at 5 p.m., here's a little incentive I'm going to show here for you. And it ain't like some first come, first served thing. Like, you know, it's as many people that show up to this will get a copy of this book as they want here. 150 pages of wisdom. All right? So we're going to get into that next week. Let's go over the usual metrics for today here. Did you guys see this here today? Look at the market is up. Let me refresh. It's still up. Yeah, it's still up. You guys are welcome. I did this. Absolutely, I am 100% responsible for this. Look, Ethereum is almost at 3,900. I am responsible for this. The market is going up because it knows that I am about to stream, or I am streaming right now, and I'm going to shut all the FUD up and give you several reasons to feel bullish, so they're already buying in advance. They're front-running my live stream right here. Look at this. Look at Ethereum, almost at 3,900. Man, it'd be great when that thing gets back above 4,000. If you know dollar cost crypto, his stream last night, what he had said is that we really haven't started altcoin season until Ethereum is above 5,200. And I 100% agree with that. I don't always agree with dollar cost crypto. So when he and I agree on something, you know it's 100% true. When he agrees and I agree, because we're just different people. We got different opinions. So 5,200 Ethereum, that's when altcoin season begins, and you got about like 2 weeks of euphoria ahead of you, and you better be watching very closely, because the thing that everybody forgets about alt season is that it goes by very, very fast. Very fast, yep. It's a very short amount of time that it happens in. All right, so all you guys out there that are joining me right here, go ahead and throw something in the chat. We'll do some questions later on here. If you got questions, I've got answers. But go ahead and introduce yourselves. Let's have a little bit of fun here with it. Now, what am I really happy about? What should you be really happy about other than prices being up here today? I mean, they still got a long ways to go here. But I think what we should all be really happy about is these prices here. Look at that. The pulse chain version of Hex is almost at 1.3 cents, and the Ethereum version of Hex is at 0.0021. Pretty good. And let's see. Pulse chain itself is almost at Quattro 04, or Quattro 05, actually. It's almost 4 zeros and a 5. And once we're at 4 zeros and a 5, well, we're halfway through to the SAC price, which is great. Like, once we reach that price there, then a lot of people are going to be like, oh, wow, man, we are back to where we were here. Now we can all stop bitching and complaining, and we can start enjoying the euphoria that's yet to come. All right, so those are our Hex prices, or our Richard Hart ecosystem prices for today. But what's the most important thing to watch out for? I said it a gazillion times. It's the 10-year Treasury. That is the most important thing in all of financial markets and all of investments, because every single analyst out there looks at the 10-year Treasury. Some of the imbeciles that want to argue with me on Twitter but are too cowardly to come on stream with me here, they want to pretend that this thing doesn't matter, even though I've shown time and time again that there is a perfect correlation between what the 10-year Treasury does and what all these investments do. You guys want to claim that there isn't a correlation, but clearly there is. And also, the dollar index. Look at this. Oh, what the heck is this? These stupid captchas. Okay, look at this. It's down today, and crypto is up. Again, I am proven right. Now, this needs to get down to like 92 for us to have those parabolic bull runs that we're all used to. Oh, hello there, Tam Tam. Nice to see you here. But yes, as I was saying, this needs to get down to 92 for us to have those parabolic bull runs that we all love. And it's got a long way to go before any of that happens. So we're still quite a ways away, but I do believe that it's going to happen, and I'm going to show you today why I believe is going to happen, and you're going to believe it too after watching what I've got today. Man, I got a lot of charts today to show you too, and these charts really going to prove everything beyond the shadow of a doubt. We got some good news earlier this week here with the Fed looks like they're about to pivot and reverse course. Well, actually, you can't call this a pivot. See, a pivot is when they either stop raising or stop cutting, and they've just been pausing for a long time here. So this really isn't so much a pivot, but it's like it's finally about to do what we want them to do. They're going to cut rates, and we think that there might actually be 3 cuts this year. So this next meeting, I think it will go down to 4%. And then in the October meeting, the futures markets are betting that it will be at 3.75. And then in the December meeting, the futures markets, by majority here, believes it will be at 3.5 or 350 basis points. So that's 3.5%. Basis point, if you never heard it before, all it is it's just a percent of a percent. It's a 100th of 1%. So we say 350 basis points. What we mean is 3.5%. And this saying here that, hey, with the way things are going right now, it is very possible for us to be at 3.5% in the federal funds rate by the end of this year. That would be great news, guys. Absolutely great news, because that's almost a full point down from where we are right now. And I know a lot of people out there, they want them lower. They want it down to like 3%, 2% or something, which can happen. It won't happen this year, but it can happen. But just the belief that things are going to be cut by that much in this year with just 3 Fed meetings left, this is huge, you guys. This is very close to the money printing bonanza that I've been talking about, that I've been constantly raving about, the money printing bonanza that's going to make you so filthy rich. You're going to be so filthy rich that you're going to be lining your bed mattress with $100 bills if you've been doing everything right up to this point, and you keep doing everything right. You keep dollar cost averaging. You keep buying those asymmetric purchases, and you don't sell, you don't cheat out. When you see this money printing go off, and when I show you the charts that I'm going to show you today here about the liquidity that's about to be created and flushed into the market, you're going to be so incredibly rich beyond your wildest dreams. I mean, I'm not telling you to go start picking out your McMansion right now. In fact, I'm going to tell you to wait when it comes to buying any sort of real estate, because I think there's going to be a very hard correction. I don't want to say crash, but I do think there'll be a hard correction coming up in real estate where prices are going to be a lot lower than they are now. Because you got to remember here, is like a lot of these people that are checking out of the housing market, they're making decisions that are going to keep them permanently checked out or very long-term checked out of the housing market. Because you see, buying a house, it takes a long time to be able to save up the money for a down payment. It takes a very long time. And the moves that a lot of people are making with the despair that they have over housing right now is preventing them from being able to get started on that. So this is something where, yeah, that housing market, when the prices come down, they can come down real hard and stay down for a while, or keep going down for a while, because housing, it moves very slow. And when it finally does turn around and start going back up, that's going to be a very slow process too. And all you homeowners out there, like, I know this is something everybody gets very emotional about. Whenever I say, hey, there's ever going to be anything bad happening to the housing market, and all the homeowners go, ah! And I was about to say, so if you own a house right now, you want the housing market to go down. You want those values to go down, because that's what your property taxes and your homeowner's insurance is based off of, is those market values. So don't be fighting me or any other analyst that's saying, hey, housing is heading straight for hell. I'll be going, no. You should be cheating it. Because if you're going to stay in your house for a long time, like the next 10 years, you do not want to be paying high property taxes and high property insurance. Because I'll tell you, those two things right there, that's part of the reason like why housing is in so much trouble, is because when it comes to the PITI, the principal, interest, taxes, insurance, the second half is getting to be higher than the first half. Kirill, you asked me to do is that are they going to fall in Europe? I'm not familiar with the European market, so I couldn't really say for sure. I will say, though, that historically, housing corrections have been global. I can say that. I don't know if it'd be again this time. I don't know that much about the European market. But if it gets to a ridiculous height and incomes are not rising with it, one of the two things is going to have to give. Either incomes are going to have to go up. I don't see that happening. Or prices are going to have to come down. And I do see that happening. So this here, guys, is incredibly positive news that the Fed is now looking at cuts. I was thinking maybe they weren't going to do any cuts until next year. And before I said that, though, I was saying, hey, might not be till September before things get running. Looks like my first prediction was the better one because things may start turning around in September. And oh man, when the things turn around, it's going to be incredible. I mean, I'll show you an example of this. I'm going to show you more about this next week. It's another reason to watch next week. But when things get turning around, take a look at Alovvium. You heard about Alovvium? Look at this guy. I mean, this thing had just been down for so long. I think it even got down into single digits not too long ago. Where was that? Yeah, it was way back here. So this thing had been sucking for a long time. And then, let's see, but it finally made it down here into, no, I guess it never went, well, no, it did. It went down into single digits in July. Man, that would have been a great price to buy it at. Because if you bought it there, you already doubled your, this thing had been going down, and then, zoom, look at that. That parabolic God candle that doubled the price in about 2 days. You're going to see this all over the place in the real bull run. This is going to be incredibly commonplace in the real bull run. And I noticed this here because outside of the Pulse Chain ecosystem, outside of the Richard Hart assets, my other big bags besides the Sonic ecosystem are gaming tokens. And I'm not saying get into it. You want to only get into the things that you really believe in and everything. I do believe in the gaming tokens and everything, in the gaming GameFi space. But when the bull run really gets going, you can practically throw darts at your computer screen on CoinMarketCap, and whatever coin that the dart lands on, you could invest in that coin, and that coin is going to go up just because of how much money is about to be what we have previously known as the 4-year cycle. I just call it the crypto cycle now. That's the true cause of why real estate has been blowing up, and that's the true cause of why the stock market right now is at all-time high. And I've got charts to show you today to prove that. So this is just an example of what's going to be very commonplace, either probably say starting November of this year or right away next year. This is going to be very typical to see candles like this in just about any asset you can think of. But another real good story that came out here. Trump signs order allowing alternative cryptocurrencies, private equity, and 401ks. I love this. I love this here. Now, this isn't opening up the floodgates yet. This is just taking the lock off of the floodgates. Because you see, the way 401ks and everything work is the employer that offers it to the participants, to the employees, has to approve of all the investments that they offer. So if an employer is into crypto, they think, okay, well, crypto's great. I invest in it personally. I'd love to offer that to my employees. Maybe he'll put it in there. This doesn't guarantee that employers are going to do that. It doesn't guarantee money's going to do it. But it's a very important first step. It's a very important first step to be able to have those boomer assets be able to go in there, have the option open, and as financial advisors get more educated on crypto, and as they become more comfortable with it, they may start recommending it to a lot of people with 401ks. So this is a good first step, and it opens the door for a couple trillion more dollars to have the potential to go into crypto. But don't take this as like a reason to spike the football yet. However, you ain't got to worry, though. We got an amazing bull run still ahead of us. I think this is probably going to be a much bigger deal in the next bull run, in the next cycle. I do think we got one more of those left ahead of us. So this here is going to be some great news. We may come back to that next week. But this here, another positive story. We will see a lot of positive stories in the days to come. Another thing we'll talk about next week. If you want this book for free, check the show out next week, Thursday at 5 p.m. I will tell you how you can get a free copy of this book, Your Parents Were Wrong. I know I mentioned it earlier. I mentioned it again here because I didn't see all of you people here earlier. So, Your Parents Were Wrong. This was a book that I wrote, and you will get a copy of it for free if you do what I say to do next week. One of these copies of your very own by tuning in to Shut the FUD Up next week. All right. So, today we want to talk about the great global money hose and why suddenly, without warning, the world is going to be soaked in cash again, like they were in 2008, like they were in 2021. All right. And here's how it's going to happen. You see, the global economy, it isn't really growing. A lot of people think, well, we're growing. No, we're not really growing. That's a bit of a misnomer, or it's a bit of a myth here. You see, that's a bit of a misnomer, or it's a bit of a myth here. You see, if we had a population that was increasing the way that it was, say, from the 1940s to the 1960s, if we had a population that was increasing like that, absolutely we'd be growing just because of the fact that there's more people, then there's more demand, more mouths to feed means there's more work to do, more employment opportunities. But we don't have that. Population is shrinking. And this concerns a lot of people because, I mean, it's not really a problem if we have a sane economy. It's only a problem because of the economy that we have here, which is a Ponzified economy. So we're really not growing. What we're doing is we're recycling our own debt, just like the snake eating its own tail, and we're calling it progress. So I'm going to show you some charts here that show this here. It shows that roughly 75% of all financial transactions going on worldwide are really just debt rollovers, just debt being refinanced and rolled over and pushed out and extended. There's no innovation. It's not productivity. We're just shuffling IOUs from one spreadsheet to another. And it gets better. Liquidity, which when I say liquidity, what I want you to think of is just the amount of money that is sloshing around the system worldwide. Liquidity needs debt. And that's why we have all the debt running around the world that we have, all the debt circulating. Because 80% of modern lending relies on collateral, something that they can claim in case the debt gets defaulted on or it doesn't get paid. Some examples of this would be mortgages. And you borrow money for a mortgage, well, the collateral is the house. Treasuries are also a form of collateral as well, because that's supposedly a guaranteed investment. So 80% of modern lending relies on collateral because liquidity needs debt. To give you an analogy to make sense of all this here, think of it as being like pawning your wedding ring to pay for a divorce lawyer. All right? Debt needs liquidity, and liquidity needs debt. So it's like a mutual parasitic relationship. Think of like two vampires biting each other and sucking the blood out of each other forever, and the blood's just going back and forth between the two bodies. Now, there is an equilibrium, though. A bit of a deranged balance, roughly a 2-to-1 debt to liquidity. We can have twice the amount of debt in the world as the amount of money in the world. We can have a 2-to-1 debt to liquidity ratio worldwide. But when that gets out of whack, things go pop. You got too much debt and you get a crisis. That's what happened with the 2008 great financial crisis. That was also getting to be the case with COVID. We were having way too much money printing and stimulus going out there, which was funded by the government borrowing and creating debt. So they needed to print off more money to cover it. Too much liquidity, you get a bubble the size of Angelina Jolie's lips, which part of where we are at right now. We're in the middle of the everything bubble, where everything from like Beanie Babies, they start to look like viable investments again here. Everything looks good. Stocks, real estate, gold, all of that. So let's start here with our first chart of the day to give you an idea of how this has played out historically. This was something that I saw here on this one channel I've been watching called Thoughtful Money. Great channel to watch, by the way. All right. I'm going to take a look at this here. Debt as a percentage of domestic liquidity. All right. So the ratio, this line right here, 200%, this is normal. If we have twice the amount of debt as we have liquidity on the global financial system, that's okay. The world has proven that we can handle that. But notice, every time that it's gone up above that, we've had some kind of crisis, like the Continental Illinois failure, the 1987 crash, got the 1997 problem. There was this one right here in 1994. I forget, the savings and loan crisis is what it was. Yeah, savings and loan crisis. Y2K crisis, then the housing crisis, Lehman Brothers, the Eurozone. Yeah, notice this here. Roughly every 7 years, and sometimes a little more than that, but it's roughly every 7 years, things get out of whack and they go pop. That is not an accident, you guys. That is not an accident. I was talking to Tam not too long ago, and she pointed out there was actually a name for this one chart called the Benner cycle. The Benner chart, that was the one that came from like a farmer's almanac. And it's proven to be accurate. It's proven to be 100% accurate so far in history, and it looks like it might be accurate here too, especially if this bull run extends all the way into 2026. This thing is freakishly accurate. And according to this here too, it looks like it is going to go by that. How that's possible, like how this guy knew, this one farmer knew exactly which one was, or how he knew which years were going to be the good years and which years were going to be the bad years. I've got a theory as to why that is. Can't really say for sure that it's true, but I do got a theory. I'll probably get into that later. But this is what I want you to see here is when debt starts to go too high, we knock that liquidity ratio out of whack. We got too much debt for too little liquidity. That's when the Fed has to step in and print money. Or sometimes it doesn't even have to be the Fed. It can be other banks, like commercial banks. They all have... Okay, reconnecting. Okay, we should be reconnected and everything should be working just fine. We'll see. So you guys just let me know in the chat if it's all working right here, because YouTube being ghetto again. All right, so I think we're all right. Now, where was I here? Oh yeah, I was talking about the this chart, which I need to share with you guys again. Here we go. Okay. So after the great financial crisis, and again during COVID, central banks like the Federal Reserve, they flooded the world with money. And they also slashed interest rates to near zero, or in some cases even below zero, which basically paying people to borrow money. It's like the financial version of please steal my bike. And this allowed everyone, households, corporations, governments, to refinance debt on the cheap and push maturity dates out further. Maturity dates, a big chunk of debt is going to mature between 2026 and 2028. Big chunk of debt. And by 2027, there's going to be about $4 trillion that is going to need to mature. $4 trillion worth of debt each year is going to mature. And it's going to need to be refinanced because nobody ever pays their debt back. And so that adds up to the global wall of debt reaching $40 trillion. And it's going to hit like a freight train made entirely out of IOUs. That's what we're going to see here in the orange space on this chart here. Let's show you this here. It's my next. Yeah, here we go. Change in the annual debt roll. So take a look at this here. It's like, notice during the good times, like 2021, that was a pretty good year economically and a good year for us in crypto. There wasn't a lot of debt that needed to be refinanced that year. Now, there was a lot of money that was coming. There was a lot of money that was being printed the year before with COVID and everything. And there was a lot of debt that needed to be refinanced and rolled over in 2020. A lot of that went on. But because they printed a whole ton of money and they got all the debt rolled over in 2020, they didn't have to do that much of it in 2021. And so we had a nice ride ahead of us here. But what happened was, this was the zero interest rate policy era from the entire year of 2021. That meant a lot of people refinanced their debts and pushed them all the way out to here, 2026, 27, 28, 29. Almost $4 trillion a year is going to need to be rolled over in those years. And that debt that's going to need to be rolled over is going to cause the debt to liquidity ratio to get out of whack, and they're going to have to print money again in order. That's the thing. That's what's causing that's what's going to cause all these asset prices to go up. All right, that's going to be the real cause. That's where all the new money that we need is going to come from. Here's the thing, though. These later years that you see all in red, the 2026, 27, 28, 29, no one has a plan for them. Not the governments, not the Federal Reserves, not even the supposed lizards at Davos who run the world while pretending to care about biodiversity. They ain't got no plan for those next 4 years. Now, let's dive into this glorious and utterly broken world of collateral markets, also known as the repo system, which basically is the financial system's pawn shop. You hand over your treasury bonds and someone gives you cash, and it's like loaning your Ferrari for a week so you can buy groceries. To look at that, we look at what's called the MOVE Index, which here it is. Yeah, the MOVE Index. If you've never heard of it before, what it stands for, or where the name comes from, is that's the Merrill Lynch Option Volatility Estimate. So I guess really what it should be called is the Love Index, but they like to just call it the MOVE Index. Think of it as like the VIX of bonds, all right? The Volatility Index, it helps investors track volatility across U.S. Treasuries, and sometimes it can signal future action in equities, which means U.S. Treasury volatility, well, it's been all over the place lately, as you can see here from this chart. And normally, how this should play out is it should hover somewhere between the 50% mark to 90%, which is this gray zone. This is where it should be normally. That's how the volatility should be controlled with treasuries. But look at here. Lately, it's been going haywire all over the place here. Look at it. Like a EKG monitor for a psychopath is how this looks. Why is that? I mean, it's been calming down a little bit here lately, but right now, it spiked recently to 200. It's like a cardiogram flatlining and then suddenly breakdancing. And that spike signaled some serious stress in the collateral system. It was like, oh my God, we're out of poker chips. That level of bad is what that was like. Now, the world didn't collapse because luckily the Fed stepped in, which they always do. So I don't know if we can say luckily. I think we can say reliably. The Fed stepped in with some buybacks and reverse repo unwinding. It basically just means that they're bailing out this little pawn shop that we use for the financial world, which it means they threw a load of cash and duct tape at the problem until it stopped screaming. So the MOVE index dropped. You can kind of see that happening towards the end there. It's going down. The repo markets start to calm. And for now, we're back to pretending everything is just fine. That's the way we look at this. We just go, oh, nah, it'll be fine. Now, what's also worth watching is another chart like this here. We call this the Sofur Federal Funds chart here. Sofur, if you hadn't heard of it before, this is something that's like really big in banking, really big in finance. It stands for the Secured Overnight Financing Rate. Have you ever heard of LIBOR? This basically replaced LIBOR. LIBOR was the London Interbank something rate. I forget what the East or the Ost or overnight rate. Yeah, the London Interbank overnight rate. They don't use that no more. Now they use what's called Sofur, or I like to call it the Suffer, because that's what all it makes us do is suffer. So we're watching this thing here. This chart is the spread between the Suffer rate and the federal funds rate. And we say spread. If you haven't heard that term before, it comes up in finance a lot. It just means what's the difference between the two rates, between the secured overnight financing rate and the federal funds rate. What's the difference between that? The difference is the spread. So if Suffer is 5 and federal funds is 4, the spread is 1. Now, it sounds like something you'd, like when I say the Suffer FF, that sounds like something you contract on a weekend in Vegas, but it's actually a key stress gauge here. It's a measurement of just how wild these markets are getting. Now, it's getting back to normal here, too, because you notice the two black dotted lines? That's the normal range where we want it to be. And it's getting back to normal because the Fed keeps jamming the reserves into the system like they're trying to feed a very expensive pig. There's also talk going on now of the Treasury rebuilding the Treasury's general account, or you might hear it called the TGA. All that is that's the government's checking account. Figuratively, when they collect taxes, our tax dollars should be going there. That's where they figuratively should be going. They don't really go there, but ideally. So there's talk that they're going to rebuild that account by $500 billion. And you're like, well, that sounds responsible, doesn't it? Doing that too quickly would suck liquidity out of the repo market, and that would spike all the rates on all of the different rates, federal funds, the Suffer, and mortgage rates, treasuries. It would spike those rates by at least 25 basis points. And that's not a little bump. It's 25 basis points in the bond world is trillions of dollars. So it's not a little bump. It's a giant pothole with a big warning sign that says, warning, black hole ahead. Now, personally, I don't think they're ever really going to rebuild the Treasury's general account. Not with markets being as fragile as they are. It would be like performing heart surgery with a sledgehammer. And even Janet Yellen would know better than that. Way back when she was our Treasury Secretary, she knew not to do that. So the U.S. Treasury market, it's still the spine of global finance. It's the thing that matters the most here. That's why all the analysts care about it. That's why I keep screaming about it. Right now, the 10-year yields are kind of behaving. They were at 4.5 earlier last month. Now they're down to 4.2. In that range, for the most part, they're behaving. But rising term premiums, I say term premium, I just mean how much more a 10-year treasury pays you over, say, a 1-year treasury. Rising term premiums are flashing a bit of a warning sign here, kind of like a check engine light. But unless yields break their trend, we're really not in panic mode yet. And for that, I've got this chart. Where did I have that chart? I had a chart here for it. Where did I put it? Not there, not there, not there. Where is it? Sorry, you guys. Okay, here we go. Yeah, this chart. You can see because I got that thing in the way. Okay, so the 10-year Treasury yield is what we're looking at now. And what this index is telling us here, I mean, the solid orange line, that's what the actual 10-year Treasury yield is. And then the dotted orange line, well, that's just showing what the trend is. But then the black line, what that's telling you is that's the premium. That's the premium. Kirill says you can't see the chart. I mean, I'm seeing it up on the screen right here. Yeah, anybody else can't see it? There's a chart here. It says 10-year U.S. Treasury yield. If you can't see it, throw that in the chat here. But what you should be able to see is that the term premium, the black line, should be at 0, while the orange line is up in the 4% range. Else says they can't see it. Okay, let me try reloading it here. All right, guys. How about now? Do you see it now? I hope you see it now. It should be. Like YouTube is saying that it's showing it. But apparently we can't trust YouTube for anything. Okay, good. I mean, it says CME no more. Hey, that's a very clever username there. CME no more. All right. So what this chart is showing us here is the term premium for going out 10 years versus the yield on a 10-year treasury. All right. And what does this matter here? What does this matter? Well, let's go back to Yellonomics. And that's a real word, actually. Yeah, just like how Brexit's a real word, or cringefluencer is a real word. Under Janet Yellen, the Treasury had been shifting toward issuing more short-term bills instead of long-term bonds. A Treasury bill, that's a Treasury that is 1 year or less. To be a bond, you got to be 10 years or more. So when we have more short-term bills being spit out and issued by the Treasury, that increases liquidity because bills are easier to flip and have a higher liquidity per dollar value. Some people call this process fiscal QE or Treasury QE, and that's a good thing. It's a good thing because basically what it is it's printing money through bond issuance. It's taken the horrifically bad and irresponsible spending of the federal government and turning it into a money printing machine. Stan Druckenmiller has a less charitable view of this. He calls it monetization of the debt. And what that is, that's just a polite way of saying the kind of economic policy you'd expect from a collapsing banana republic. So we got good times ahead of us now, don't we? But globally, around 80% of central banks are now easing. And that's not a typo. 80% of central banks around the globe are now easing. That's why you're seeing the Federal Reserve say, well, hey, now we're thinking we're going to cut. They're going to be doing the cuts for the next 3 months. The next 3 meetings, there's going to be cuts. It's because the rest of the world and their central banks, the Europeans, the Japanese, the Chinese, they're all saying, yep, we're going to start easing, or we're going to start doing quantitative easing. That's most of the planet's monetary policy. They're all saying, yeah, we give up. So here, have some money. The biggest source of all this volatility actually is China, because their stop-and-go stimulus policy is like watching someone try to inflate a balloon with a leaf blower, and then they suddenly change their mind and start stabbing it with a pen. But still, they've already injected $1.5 trillion, and more is expected from them. And if they keep going, we could see a surge in commodities because Chinese liquidity almost correlates perfectly with the Commodity Research Bureau Index, or the CRB Index. Basically, think of it like this here. If Beijing sneezes, copper prices get pneumonia. All right? Now, what do you think happens to crypto when that happens? It goes up too. because you got all this new money being printed off and injected into the system. It's got to have a place to go. It can go into commodities, it can go into financial assets, or it can go into crypto, which they like putting it in there just because it only takes a tiny bit of money to get that thing going, get the reflexive system working, kind of like powering up one of those old lawnmowers that you got to pull the cord for, because once you get it going, it can go for a long, long time. Now, the Federal Reserve hasn't started easing yet, but it looks like they're about to in September. The markets are already pricing in the cuts because the economy is slowing. That chart I kept showing you that shows 50 states and 39 of them are in recession. They're out of options that don't involve lighting money on fire. So where does that leave us? In a world where the entire financial system is basically a house of debt propped up by duct tape, spreadsheets, and central bank prayers. We've got liquidity climbing toward a peak. We got a mountain of refinancing coming in 2027. Repo markets are twitching like they've seen a ghost. We got China playing economic whack-a-mole. And the Fed is pretending everything is data dependent, as Jerome Powell likes to say. But really, that's just economists speak for, we know that we need to cut and turn QE back on, but we don't want to admit that because that will make us look subservient to the president, and we just can't have that now, can we? So, now you understand why every financial chart looks like a heartbeat monitor having a nervous breakdown. How does this fit in with the overall cycle, the debt cycle, or you can even call it the liquidity cycle or the credit cycle? How does this fit in with the seasons? And I would say there's seasons to liquidity. It's not seasons where leaves fall and everybody pretends that pumpkin spice is a new personality trait, but the 4 seasons of liquidity. And it sounds like a terrible progressive rock album, but it's actually a fairly elegant way to describe the market's mood swings. And I have a chart here for you on that. Where did I put it? Not that one. It's going to be this one. All right. So zoom in a little bit here so you can see the years and everything. And what you'll notice here is that it actually follows that 7-year pattern. If you look down here at the bottom, these bottom troughs and even like the top peaks and everything, they seem to be separated by 7 years. I'm going to do this here. Like anybody in the chat, if you know why a lot of the liquidity cycle and debt cycles are 7 years, if you know why or what it dates back to, it dates back to something very, very old. If you know what it is, throw it in the chat. I'm curious if anybody knows. But financial markets, they're basically a hormonal teenager with a trust fund. Sometimes they're calm. Sometimes they're manic. A lot of times they're defensive. But they're always one bad decision away from setting everything on fire. The market goes through a 7, sometimes 8-year liquidity cycle, and it gets divided into 4 phases. I've got a picture of those phases right here. No, not there. Sorry. Here it is. The global liquidity cycle. Check this out here. We've got our first season, which is turbulence. That brings things all the way down to the bottom. And then from there, we have the rebound. After we've rebounded significantly past where we were before the turbulence, we call this area the calm. It's not really calm. It's actually a lot of crazy parabolic runs and everything. But we call it the calm for some reason. And then after that, we have the speculation season. To put this into crypto terms, here is the bear market. This is what everything looks very nihilistic and full of despair. Here is the Bitcoin, sometimes Ethereum bull run. Usually it's just Bitcoin by itself having its own bull run. And then here is alt season. And Yeah, what else you could tack on to that there is after alt season, then it's meme coin season. Because we just can't be we can't just speculate on the altcoins. No, we gotta speculate on meme coins on top of that now. Now, in the calm part of this is the low volatility where everything is climbing. If there's any volatility, it's volatility to the upside. So stocks are going up. Everything's looking stable. Bitcoin is climbing before every other coin. It's kind of like the eye of the financial hurricane, but with better stock options. When we get to speculation, though, we got that bubble-like madness where the commodities spike, the small caps and the altcoins rally, and every YouTube investor you never heard of suddenly has a Lamborghini and a podcast. That's how good that the speculation season is. Then we got turbulence, where reality sets in. Everybody dives for cash. Gold suddenly makes a comeback. You start hearing the words safe haven a lot. And then rebound. That's when the bonds rally and the yields collapse. And the Fed acts like they saw it coming all along, even though they really didn't. Now, why do the bonds rally? A little concept called forced selling. If you haven't heard of this before, you want to get very familiar with this term, forced selling, also forced buying, because this is what causes bear markets, or at least I think this is the first snowflake that starts the avalanche that becomes the bear market. The forced selling done by allocation funds. You see, if I have a allocation fund that's supposed to be 50% stocks and then 50% bonds, but then stocks had this amazing run and they went all the way up here. Well, the charter of my fund says I need to maintain that 50% allocation. So what I have to do is I have to sell those stocks and take the money from them and plow it into the bonds to balance that fund back out, balance the allocation. When that happens, I'm pulling money out of stocks, I'm pushing their prices down, I'm plowing money into bonds, I'm pushing their prices up. This is what causes the bear market in stocks, and I think it bleeds over into crypto and causes the bear market in crypto because that's what we saw in 2022. So where are we right now? I'd say we're kind of right on the razor's edge between the end of the calm part of the cycle and the beginning of the speculation side of it. It's an early speculation phase. That's when alt season really begins and blows up. That's when Ethereum is going to start its season at $5,200. And then from there, it could go all the way up to $22,000 is what I'm hoping it does. It could go all the way up to that. But a lot of people are just saying, well, it'll be a $10,000 or it'll be a $15,000 ETH. I think the amount of money printing that's going to be done, it could be $22,000. But the speculation and alt season doesn't happen. It doesn't start till Ethereum's at 5,200. So what's hot right now? Well, stocks are hot right now, especially the technology, the financials, and the small caps are kind of thriving like mold in a poorly ventilated apartment. And notice the stock market's at all-time highs right now. That's not an accident. Commodities getting spicy too. You think of like energy, metals, the things that you dig out of the ground and light on fire. If the pattern holds, commodities are going to peak as we enter into late 2025, early 2026, because it's going to be fueled by the Chinese demand, the supply constraints. It's going to be like musical chairs, but instead of chairs, it's barrels of oil. Now, we roll over the top. Once the music stops, and we enter that please don't lose everything phase, crypto, commodities, and stocks, they hit their top and pop out. The party ends. In your portfolio, if it's still 100% alts, it's going to cry itself to sleep at night. From 2026 to 2027, that's when the smart money is going to pivot. Now, some of it is forced buying and forced selling because of allocation funds, but smart money is going to try to front run that. They're going to get into defensive stocks like pharmaceuticals and food manufacturers, the things that we need when the world burns. They're going to go into cash, and they're going to go into long-dated bonds, which will become hot again, and yields will collapse like a badly made souffle. Because when volatility spikes and everyone's refinancing debt at gunpoint, there's nothing sexier than a 30-year Treasury bond yielding 2% and not collapsing in value every Thursday. Now, Why do I say global liquidity is going higher? I wanted to show you this chart right here that basically kind of maps out how this all happens. What are the mechanics of a liquidity cycle? And this here, like, if it doesn't make sense, it's all right. It doesn't necessarily need to make sense here. Like, I think the better thing to know is why the liquidity is going to go up and why the debt that causes liquidity to go up is going to go up as well. Because remember, for them to start that money printing, they need that debt to liquidity ratio to go out of whack. It should be 2 to 1 debt to liquidity. It's got to go higher. The debt's got to go higher. It is going to go higher. And I'll tell you why. And what does that have to do with crypto? And why does what I know about debt and liquidity make me confident that the crypto market is going to go way higher than it is now? Well, that all brings me to a question that makes policymakers squirm and economists fidget. How much of the U.S. economy do you think is literally just government overspending? Anybody know the answer to that? Throw it in the chat if you do. And I'm guessing nobody really knows the answer to that. Prove me wrong, though. I'm happy to be proven wrong. Tabarus says 97%. Not that high, but... Well, here's the answer I'll give you here. More than you should be comfortable with. Because the economy, the mighty chest-thumping, bald eagle soaring beacon of capitalism, which we're not a capitalist country. It's running not on innovation, not on productivity, but on federal government burning through borrowed cash like it's playing Monopoly on meth. Here's a little breakdown for the non-nerds out there, the people that actually get laid. Deficit spending is what happens when the U.S. government spends more than it earns in revenue, which is always. It's the financial equivalent of earning $20,000 a year and still buying a Tesla because, well, future you will figure it out. Or you earn $30,000 a year and you go buy a McMansion and a Range Rover because you just got to win the Cold War with your neighbors and impress them, even though like they secretly hate you behind their breath. Well, yeah, at least when they walk out and mow their lawn, they smile at you, right? That's what you want, isn't it? Well, that's what deficit spending is. And the deficit spending that the United States government does injects cash straight into the economy. It's not theoretical. It's not subtle. And remember, one man's spending, according to the Keynesians, one man's spending is another man's income. And government spending is many men's income. That doesn't make it good, despite how hard Paul Krugman is jerking himself off over it. That's like weighing yourself with 1 foot off the scale and saying, oh, look how healthy I am. But in 2024, the U.S. ran a $1.8 trillion deficit. According to the CBO, that's about 6.6% of nominal GDP, which is about $27 trillion. And that's just the raw injection. It's just one little piece of it. Once you include what we call the fiscal multiplier, and the fiscal multiplier, that's how money sloshes around the economy and triggers more spending, the real impact is bigger. It's like the same $1 bill can bounce around multiple participants as it's being spent and trading hands. That $1 bill can generate lots of economic activity all on its own. We call that the fiscal multiplier. Now, if the multiplier is 1, you're looking at a 6.6% boost in GDP just from a $1.8 trillion deficit from the federal government. If it's 1.5, and it often is during slowdowns, then you're pushing about 9 to 10% of GDP is propped up by the federal government's overspending. So yeah, roughly 1/10 of the U.S. economy is just Uncle Sam shitting out more borrowed money. Now, this isn't new. Every time things go sideways, the U.S. government whips out deficit like a financial Swiss Army knife. In 2009, the great financial crisis, the deficits hit 9.8% of GDP because apparently TARP and quantitative easing weren't enough. They had to throw in the fiscal kitchen sink. 2020, we had COVID. Deficit explodes to 14.9% of GDP. That wasn't stimulus. That was an emergency resuscitation with a $1 trillion money cannon. But even outside of recessions, the United States runs consistent deficits. From 2017 to 2019, they averaged about 4 to 5% of GDP. So it's like a drunk who promises he'll cut back after the holidays, but keeps ordering wine by the barrel. I got a visual for this here to show y'all. It's my first one here, but there we go. The U.S. federal deficit as a percentage of GDP. Normally, it is at 6.6%. That's this red line. But in times of crisis, it's a lot more. As you see here, 2020 went all the way up to nearly 15%. That was when they were sending out, as Toll Russe there says, is $12,000 or $1,200 a person. All right. So they have to keep spending. They have to keep borrowing. They have to keep taking on debt and get the debt to liquidity ratio out of whack. Otherwise, if they stop doing this, our economy would contract and GDP would be negative. And no politician wants to preside over that. The deficit, though, here's where it gets real juicy. The deficit, that's just the gap between what the government spends and what it brings in. Because see, in 2024, the total federal spending was $6.8 trillion. That was 25% of GDP. 25% of America's GDP came from federal spending. And the deficit, it was short $1.8 trillion. That's the portion they didn't have the money for. They just borrowed it. That's spending that includes Social Security, the glorified intergenerational Ponzi scheme, Medicare, because American healthcare has to cost more than Mars exploration. That includes defense spending, which somehow still growing despite nobody knowing where half of it goes. And interest payments, the fastest growing line item, which is basically just paying off the credit card interest within our credit card. There's also transfer payments like Social Security and stimulus checks. They don't just vanish. They go into the economy, they buy things, and they prop up consumption. So whether it's building tanks or sending grandma $1,200, the result is the same. GDP go up. And you might think, well, yeah, okay, but doesn't this cause inflation? Yes, but also no. Because in a world where the Fed monetizes debt via fiscal quantitative easing, issuing the short-term treasury bills, boosting liquidity, it becomes more like a game of musical chair where someone keeps adding more chairs. So that's why Scott Bessent wants to issue more T-bills than treasury bonds. So that's the latest financial wizardry they're doing at the Treasury. Fiscal QE, they call it, where short-term bills being issued out, the Fed indirectly absorbs it, and voila, liquidity goes up. The GDP gets a sugar high, and everybody pretends it's just good economic management. They're going to do this because they want to borrow more money, but they don't want to cause inflation. Oh, and the interest on government debt, now that's acting as a transfer payment to the private sector, which means the government borrows money and then pays you interest on it. You go out and spend it, which props up the economy again. It's like stealing your own wallet, giving yourself a loan, and then bragging about how generous you are. All of this points to one very uncomfortable conclusion. A non-trivial chunk of U.S. GDP, we could say 5 to 10%, is entirely reliant on the government spending money that it doesn't have. It's not a glitch. It's not a one-off. It is the system. And the only thing keeping it running is the belief that someone somewhere will keep buying treasuries like their concert tickets to the end of capitalism. Now, what's all this mean for you? If GDP growth numbers are juiced like a cyclist in the Tour de France, it means fiscal policy now drives more of the economy than we care to admit. When I say fiscal policy, what I mean is the federal budget, how much money Congress agrees to spend from the Treasury. It drives the economy more than we want. And by 2026 to 2027, when that debt wall hits and deficit monetization starts to creak, we might discover just how flimsy this system really is. And of course, the bears out there are going to, the bears that are too chicken shit to stream with me might say, yeah, well, what if the U.S. government just stops deficit spending? You know, like it suddenly found Jesus and decided to live within its means and balance the budget. Sounds noble, right? Except that would be like ripping the engine out of a plane in the middle of a flight and hoping the wings get really ambitious. It's like asking, what happens if you take the yeast out of bread? Well, you still have something, but it's sad and it's flat and no one wants to eat it. It's the government. If the government stops deficit spending, cold turkey, you're looking at a $1.4 to $2.7 trillion hit to GDP. 5 to 10% of the entire U.S. economy gone. Poof. Like crypto gains in a bear market. Now, put that into perspective. The entire 2008 recession, that caused GDP to shrink by 4.3%. So a full stop in deficit spending would be worse than the great financial crisis. At least we'd have a balanced budget, right? Hooray! Okay, now maybe we don't go to cold turkey. Like maybe we'll say we just want to cut the deficit in half. That sounds sensible, right? Sure. But it's also terrible. A 50% cut would be reducing spending by $900 billion, which again, thanks to that pesky fiscal multiplier, would knock about 2.6 to 4.9% off of GDP. So you're running a 2% growth rate, which, give or take, you're now at zero. Or worse, say hello to recession, goodbye to jobs, earnings, or your illusion that America functions like a responsible adult. And of course, they'll say, well, but the private sector will step in. Will it? You really think so? Because let's say the government stops pumping cash. The theory that's been peddled by economists who haven't really left their tenured offices since Clinton was in charge, I'm looking at you, Lawrence Summers, is that private investment will crowd in to fill the gap. There's the problem. The private sector, it just ain't in the mood, you know? Like a housewife during the 7-year itch. Oh, honey, I'm not in the mood no more. The consumers are still recovering from inflation fatigue and the rent PTSD that they've all been suffering from. Businesses are facing tariff-induced uncertainty, and as I've said before, they're about as eager to invest as a cat is about to go swimming. The interest rates are still at 4 to 5%. That's not a build stuff environment. It's a hoard cash and complain on Bloomberg environment. So yeah, guys, the cavalry isn't coming. But this is good because that deficit spending is a key driver of market liquidity. Every time the government issues debt, it injects cash into the system. And that cash that gets injected into the system ends up in financial assets like crypto. That is why the bull run has not yet started. When that cash gets injected into the system, it's not just into spending, but it also gets injected into repo markets, bank reserves, and collateral. And if you stop the deficits, you're going to stop all this liquidity. The repo rates will spike, the collateral will get scarce, the bond yields will rise, and asset price is going to fall faster than your faith in democracy. So the Treasury and the Fed, they know this, and that's why they won't ever let the Treasury's general account refill without tiptoeing right up to it, like they're diffusing a bomb made of mortgage-backed securities. Now, let's get existential here. The global financial system, it's not really capitalist anymore. It's more like a debt financing treadmill, and if we ever stop running, we die. About 75% of global financial activity is just rolling over debt. It's not paying anything off. It's about keeping the juggling act going without dropping a flaming sword. What fuels that? Liquidity. What provides liquidity? More debt. What backs the debt? Collateral, like treasuries. And where do those come from? Deficit spending. So again, it's a giant snake eating its own tail and calling it progress. If you cut deficit spending, you don't just slow growth, you break the machinery. The repo market sees up, the bond yields freak out, and the move index screams louder than I do when I'm stuck behind some dumb boomer that stopped in the middle of the aisle at Walmart, and suddenly you're in a full-blown panic. This is why the Fed and the Treasury will avoid rocking the boat. The economy is not floating. It's hovering about 2 inches above water on a raft made of IOUs. Now, not only are deficits unlikely to shrink, they're probably going to get bigger. Because look around, the economy is slowing. Tariffs are screwing everything up. The labor market is coughing up hairballs. The Treasury yields are above 4%, which is low enough for Uncle Sam to keep spending like one of Matt Walsh's sons with someone else's credit card and access to OnlyFans. The CBO projects that deficits are going to hit over $2 trillion by 2028, and that's an optimistic scenario. If you factor in the interest payments, the healthcare costs, and the fact that the government is running out of vibes, running out of borrowed cash, you could see 8 to 10% deficits just to keep GDP from tanking. And remember, there's a $40 trillion global debt wall coming in the year 2027. Government's going to need to refinance a mountain of IOUs. And how are they going to do it? I'll tell you how they're not going to do it. They're not going to do it by cutting spending. And let's not forget, the last time that we tried austerity was back in 2011. It slowed growth and it pissed everybody off. And we still didn't eliminate the deficit. So it's not happening. Now, where does all of that leave us? You see, cutting the federal spending like we all kind of want to, well, it risks a recession. Politicians are not going to do it. Global liquidity props it up, and markets need it like an addict needs a fix. And the deficits, they aren't just likely to continue, but it's baked into the operating system. It has to continue. We may hit a wall eventually, like in 2028, when the debt refinancing storm makes landfall. But until then, you can expect that these deficits keep going up. You can expect more spending, more liquidity, and more insane charts that look like heart monitors having a stroke. This is why I think there might be one more crypto cycle after this one, because the economy has to have more debt cycles occur, or else it's just going to take a giant Jurassic shit. And at which point, we're not worried about crypto prices if that happens. We're worried about what are we going to eat that isn't each other. So no, I don't like all this federal deficit spending. No, don't get me wrong here. I'm not like some Keynesian progressive person here. I'm not some liberal that is rooting for all of this. I don't like the deficit spending, but the time to care about this was back in 2012, and America chose not to care about it back then. They chose to prioritize free shit over freedom itself. So the best thing for us to do now is learn how to play within this screwed up system. The best thing for you to do now is learn how to operate in a world where debt is oxygen, or learn how to breathe in smoke. Because that's how it plays out in this system that we currently have. All right, so heading up on 1 hour and 15 minutes. I got time for questions. If anybody has questions, go ahead and throw them in the chats. Everybody listen, everybody drop them if you got them. Going once. What's going to happen in 2027, asks Tablarus. Well, a bunch of debt is going to have to be refinanced. They're going to roll it over. They don't want to refinance it at very high rates. And 5% would be considered a very high rate for treasuries. And honestly, with the size of the debt, I don't think that they want those rates any higher than 2 to 3%. They're going to be $40 trillion by then. So there's going to have to be more money printing in 2027 or 2028, really, when it will really happen. They're going to have to be a lot more money printing then. And we'll see the effects of it probably in 2029 when crypto has its next big bull cycle. That's what I think is going to happen when that global debt rolls over. Because, like, it's not a problem if they get the interest rate down. Does that mean we could have a 3-year bull run? No, we don't have a 3-year bull run. Like, I think that the current bull run will start in September or probably October or later. And that goes on for about 6 months. Or Bitcoin has its big parabolic run, its blow off top. And then we have the altcoin season after that, which lasts for about 1 month at most. Because then what you're going to have is the forced buying and the forced selling from allocation funds. You're going to have that. That's going to cause the bear market to come around. And yeah, when we reach the top here, I'm like, my stream, if I'm still streaming by then, what I'm going to do is I'm going to be telling you, hey, you need to take profits. You need to start getting out. You'll know that I'm telling you to do that here without me like really telling you to do that, because I don't want to be like the first snowflake that causes the avalanche. But you'll know that I'm telling you that the bull market is ending when I tell you my little speech on how to hide how much money you have, or why you should always hide how much money you made in crypto, and you shouldn't tell anybody. You don't want anybody to know you're rich. So when I give you that speech about why you should never let anyone know you're rich, and you should always hide your power level, you should know, hey, bull market's winding down by then. All right, anybody got anything else? Thank you, Tam Tam. Anybody got anything else here? Yeah, probably reallocate into stable coins. Probably a good idea. Oh, you know what? Here, I got one more chart to show you. Give you an idea of like how history repeats itself and how this liquidity cycle plays out. I know, like this chart, it's not a nice one here. It's not that great because it's just laying way too much stuff over itself. So the black dotted line tells you, well, this has been consistently the long-term cycle of 7 years all throughout history. Oh yeah, I forgot to tell you, like, why is it 7 years? So I'll tell you that here. So 7 years is the long-term cycle over the course of history. And in the red, this is how it played out with the global liquidity in the 80s. During the 1980s, they had two peaks, one in 83 and then one in 1988. Now, the orange line, that's following the cycle from 2019, which would be right here, all the way to 2027, which it hasn't been fully mapped out yet. It cuts off right here, which is where we're at right now, 2025. So here, this was 2021 when we peaked. Then everything started going down, took a giant dump. And then here has got to be where we're at right now, 2025, many years later, as global liquidity is on the rise back up. And you can see it still has quite a distance to go to get back to where it was. Still quite a distance there to go. That's when U.S. Treasury falls below 4%. That's when the dollar index is down to like 92. That's when all the money printing is going off all around the world. Why does this happen every 7 years? Well, it has to do with the debt cycle, which has been around actually since Bible times. If you didn't know this, there's a there was a tradition way back in Bible times. Came from I think it came from Exodus. If not, it was in definitely one of the other books that was considered part of the Dead Sea Scrolls. So Genesis, Exodus, Leviticus, Numbers, Deuteronomy. And yeah, I'm sad that I do know all of this right here because I was sent to a Jewish school when I was a kid. I was expelled from it too, by the way, but that's another story. But There was a tradition back then called the Shemitah. And what the Shemitah is once every 7 years, all of the debts were canceled. And that was written into Jewish law. They call it the Jewish law is called the mitzvah. And every 7 years, they were ordered to cancel all the debts. Now, once you get an economy rolling for 7 years based on credit and debt, but then you cancel all those debts once every 7 years, when we get to that seventh year, that's going to cause some massive waves of disruption throughout the economy, right? Absolutely. So a lot of people think ever since the Shemitah tradition was born, we've had these 7-year cycles of the debt cycle and the liquidity cycle. And it's always been like that ever since. So it's been going on probably for thousands of years, ever since the 10 Commandments were first chiseled into stone. That's what a lot of people think caused all of this here, was the concept of the Shemitah. And a lot of people think, well, maybe that's how the Benner cycle was discovered. Maybe that's how that one farmer discovered the chart here, which if you haven't seen it, let me show it to you. Like, once you have seen it, or I think once you see it, you'll be like, oh yeah, I've seen that. Where do I have that? I can make this bigger. Yeah, here we go. Share my screen. This thing here has proven to be oddly accurate. And many people are still theorizing as to why it is. I don't know why this has been so oddly accurate. Because it has, if you look back at time here, well, it's everything that it says is going to happen in years of hard times. These have been recessionary years. And how is this the case? A lot of people think, well, maybe it's this guy knew about the Shemitah, and that's what he based it off of when he came up with this. That's the Benner cycle. So, next week, we'll get into a little bit more of that. Also, next week, you don't want to miss the stream Thursday at 5 p.m. because I'm going to give you a way to get this book for free. 100% free. Your Parents Were Wrong is the name of the book. And believe me, it's a very entertaining read. If you like the way that I speak, if you think I'm funny, well, you're going to find this book very entertaining to read here. And if you just want to go ahead and buy it right now, I won't stop you. But next week, I will show you how you can get it 100% free. So you don't want to miss next week, Thursday at 5 p.m. Till then, Cairo out.